Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Dickie Hodges, manager of the Nomura Global Dynamic Bond Fund. Hello, Dickie.
Hi, thank you.
So on the walk to the studio, you described this as the strangest market environment you have ever known as an investor. What did you mean by that?
Well, I mean, a lot of the market seems to be dislocated from each other. And if you're looking at the volatility of different asset classes, they represent volatility at different times. There's no coordination. And I think that's down to the uncertainty with regard to the future of central bank and the monetary policies, and also with regard to quantitative easing. And as we've become welcome, or we're used to understand, quantitating this year from the European Central Bank will be coming to an end.
And where is there a little bit of certainty? Because it seems to be that the Fed will raise rates. That seems to be an understanding. But the speed and the level of those raises is where there begins to be more uncertainty.
I think so. And this was demonstrated very late last year. Bond markets and interest rate markets were only discounting a little over one interest rate rise at the beginning of November last year, where the Federal Reserve had been consistently telling us there will be 3 interest rate rises during 2018. And indeed, at the last March report FOMC meeting, the Federal Reserve, Chairman Powell was telling us that we are indeed going to have 3 interest rate rises and that there would possibly be more moving into 2019. Now, the market has actually fully discounted this possibility now. So what we're looking for is more indication of where we're going to see growth and where we're going to see market evolution over the course of the remaining of 2018 and into 19.
So is it maybe, as you seem to suggest, a bit more just about trusting what they're saying will be the truth?
Yes, and sometimes it's very difficult to trust what a central banker is saying. In an age where they want to be transparent, to give some certainty to the markets and to suppress volatility, we have 1 or 2 weak numbers that come out of the UK economy, for instance, and suddenly expectations of an interest rate rise in May of 2018, this month, disappear, and the probability that's priced into markets falls from a 90% probability to only a 20% probability within the space of 1 week. So transparency is good, but consistency is something that markets need to actually value assets from.
As a global and dynamic bond fund manager, you're probably better placed than most in the fixed income space because at least you have a plethora of levers to pull in order to find value. You're not tied to, say, just US corporates, for example. Where are you seeing the best opportunities within that remit?
Well, more historically and more recently, we've capitalised against the rise of interest rates and the rise of government bond yields. And I think it's less certain, and you shouldn't make the mistake, that bond yields are going to move higher during the course of 2018 and 2019, just because central banks have told us that interest rates are going to go higher. I see pockets of value in various different asset classes, from India, some emerging markets, and certainly over the course of the last 3 months, emerging markets have cheapened significantly. So if you're looking somewhere where you can gain some returns during the remainder of 2018, then I'd look into the emerging market space.
Dickie, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.